GE Aerospace. This is a company which has recently spun off from GE. And guess what? Many people already like them. Super investors own them, but my data challenges the one fact that many people think is alright. Their R&D spending. In this video, I'll take a look at the data point that is weak for this company.
Okay guys, so we are here in Market Vision and let's go check it out for GE Aerospace. So we type in GE, that's their ticker symbol. So we select this and this is the Monopolistic Traits score that has been generated by my tool. Here you can see that we have all the different metrics. Let's focus on the most negative one so far, the R&D spending. We can see here a number, 3.44%. This means that a very small amount of their total sales, or in other words, revenue, is being spent on R&D. R&D spending is necessary for any company in their industry, as they need that to innovate. Safety is, of course, their priority, so they aren't compromising on that. They also need to spend cash on safety. Here's our chart of their R&D spending coming straight from their SEC filing. We can see that from 2022 to 2023, they experienced a growth in R&D of 22%. Right now, it's at around 9%. So a bit of a slowdown. For those reasons, they have received a 1 out of 10 score. Remember that too much R&D can be as bad, if not worse, than too little R&D. This isn't to say that they are a bad company. Far from it. I think that they are a stable one. If we take a look at their gross margin, for example, we can see that it's at 31.5%. A really positive number that shows their clear commitment to cash generation. If we take a look at their ROIC, we also see that it's at a stable score, a 6 out of 10. What does it even mean? It means that for every $100 of their invested cash, they return $14. So that is a good return in my opinion. Their free cash flow margin, or the amount of cash generated by their business as a percentage of total sales, is at around 17%. Which shows that they have money left over from their core operations, which is a signal of strength for them. That money can be spent on dividends or buybacks. And recently, they have announced to their investors that they will spend around 75% of their free cash flow on dividends and 25% on non-organic acquisitions. For example, like buying a different company. So they deserve a 7 out of 10 score for that. Revenue growth versus industry. Well, they have lagged the industry by 4.97%. And while that isn't a sign to worry about right now, as the management has updated their fiscal year 2025 guidance to be at something like 15% growth, it's a metric we should definitely keep an eye on, even as potential investors, because I don't own this company right now.
So what does this monopolistic score exactly show us for this company? Well, any investor knows that in order to get a more detailed view of a company, we need that other data. Luckily, I have created my own article on my investment thesis, and the best part is it's 100% free. You can check out their financial health score there, which I made myself, their market share, and other metrics. Click the first link in the description to read more on GE Aerospace. Until next week guys, thanks for watching. This isn't financial advice.